Good morning from our global headquarters in New York. I'm Shonali Bassick, in for Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda. Countdown to tariffs. Investors await President Trump's announcement on levies. Watch out for a pullback. Chicago Fed President Austin Goolsbee warns of tariff-induced slowdown in consumer spending. And the Trump administration weighs plans to divest TikTok's U.S. operations with the proposal from Oracle and Blackstone. But first, let's get you here a check on the markets here in the United States. Futures are lower to the tune of 0.3% on the S&P 500 and NASDAQ 100 futures. The same. Russell 2000 futures down 0.4%, and the bond market holding steady. We're also keeping an eye here on individual stocks. Tesla leading Mag 7 stocks lower in pre-market trading ahead of the tariff announcements from the White House, and that is expected at 4 p.m. Eastern Time. We're looking at Encino as well, extending double-digit losses after giving a weak revenue forecast. And if that decline holds, the software company will be on track for its biggest fall on record. Finally, we're keeping an eye on Newsmax as well. It's down this morning after soaring 2,240% in just 2 days since its debut. It's getting a meme stock moment, which has given it a market value greater than Fox. And coming up this hour, we're going to have a conversation with TD Bank's Mark McCormick just around the corner, plus Adam Posen of the Peterson Institute joining us later in the hour to talk about tariffs, and more tariffs, because President Trump's tariff plans are still in limbo just hours from his announcement from the White House. His team is said to be finalizing the size and scope.
Liberation Day.
Liberation Day
This is the beginning of Liberation Day.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away.
We're in the process of imposing reciprocal tariffs.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation, perhaps.
Friend has been oftentimes much worse than foe.
That money's going to be coming back to us in the form of tariffs. We're going to be very nice. Relatively speaking, we're going to be very kind.
And for the latest, we're going to bring in Bloomberg's Brendan Murray, who leads our trade coverage globally with the uncertainties that still loom just hours away from that Rose Garden announcement. What is the world watching most closely for?
Yeah, so it looks like the White House is still debating the actual makeup of these tariffs, the kinds of industries or products they're going to target, the countries that are going to be targeted. In three basic, there seem to be three basic options. There's a flat tariff rate that would apply to every country. The number 20% has been thrown around. There's a more customized approach where each country gets a different tariff rate, and then there's a tiered approach where you would have, say, three buckets with a different tariff rate, and countries would be placed into one of those three. So the president has all these on his desk and will be making a decision, presumably within hours.
We were talking just a day ago, Brendan, about the last-ditch effort made by automakers here in the United States to get some concessions on their industry. Do we know whether the final pleas have made any difference in the way the president is approaching these tariffs?
You know, the president was very clear in the past week or two to say there's going to be no exceptions. I've already given you 30 days. He pushed these back from early March, and now we will see if he provides any sort of reprieve to the auto industry. The auto industry is saying, look, this is just going to create problems for our production lines, and it's going to spark retaliation from Canada and from Europe. So the auto companies, have a lot at stake in trying to make sure that that Trump goes easy on them with the 25% tariff that takes effect at midnight tonight.
One interesting dynamic here is the cross currents that you're seeing in the currency markets and the bond markets. The currency markets in particular, you've seen, for example, Goldman come out with a call just this morning, pitching the yen as a safe haven, for example. Corners of the market showing the idea that U.S. exceptionalism might be dying here. What is the net effect of the tariffs expected by titans of industry and investors?
Yeah, look, the word that we've heard over and over in the past several weeks is uncertainty. Businesses can't figure out what their costs are going to be. They're not investing. They're not hiring. They're just putting off these decisions and kind of sitting on their hands. And so the question for the financial markets that you just referred to is, to what degree does the announcement today resolve the uncertainty, or does it create more of it? Does the retaliation come in, stronger than anybody would have expected, or less than anybody expected? So there's the big question is whether that uncertainty, starts to diminish going forward, or whether we're just at the beginning of a whole lot more of it.
Brendan, to that effect as well, you've seen this presidential administration come in with tough stances that could then maybe be rolled back. Do you expect the same when it comes to this announcement, that the toughest offer could come first?
Yeah, that's typically how Trump rolls. He says, he comes out swinging with his heaviest threats, and then you negotiate from there. I think it depends on which trading partner you're talking about. Canada and the European Union have said, look, we're gonna match you one for one with the tariffs that you put on us. So there's definitely, Trump is a consummate deal maker. He wants to negotiate. A big part of the rationale for this is to bring countries to the negotiating table, and as Commerce Secretary Howard Lutnick said, essentially redo the trading relationships that the U.S. has with its biggest trading partners, which they feel has grown to be so unbalanced that that has led us to today, which Trump calls Liberation Day from those unfair trading relationships, in his view.
Brendan, we thank you so much for your time. We're looking forward to the coverage from you and your team over the next 24 hours and the days to come. That is Bloomberg's Brendan Murray. And don't miss our White House tariff announcement special, live at 4 p.m. New York time. Now, Mark McCormick of TD Bank weighing in on the potential impact of tariffs, writing, quote, "The market is now aggressively positioned for the end of U.S. exceptionalism, emphasizing the importance of this vibe shift. This week's tariff playbook highlights the sequencing problem we face in the market. U.S. inflation is a problem now. A stronger U.S. dollar is needed to cushion the inflationary effects of the tariffs." Mark joins us now. He's the global head of FX and EM strategy at TD Bank. Great to see you this morning, Mark. Perfect person to weigh in on these cross currents that the currency markets are signaling. What are you seeing? I'm wondering, from your perspective, from the currency market signals, are we seeing clear winners and losers?
Well, the clear loser has been the dollar, but I think a big piece of it is the market's trying to figure out whether or not tariffs and trade uncertainty, which is weighing on U.S. growth through, again, I would call it a vibe shift. Kind of what we've seen recently is, again, Europe seems to be going through a policy change that will deliver reflation, but a lot of it is backloaded. We're not going to get fiscal stimulus from Germany in the next month. It's going to come through in quarters. Same thing in the UK, same thing in places like Sweden. Again, China's been recovering. But the thing that's happening in the U.S. is the U.S. sentiment is deteriorating, but it's not clear that it's showing up in the data yet. So the point that we're highlighting is there's a sequencing issue, is that, again, vibes at some point need to match the actual data. So whether or not markets want to talk about it anymore, we are data dependent, which was the theme of last year. So data dependence is very important. What the data is telling us is that U.S. inflation is relatively high and accelerating versus other countries, which means you can't assume the Fed's going to cut immediately to cushion this shock. And the other side of it is that the tariffs themselves, the reciprocal tariffs or whatever comes, whatever you want to call trade uncertainty, is going to weigh on rest of world growth now. So the market's mispriced, in our opinion, for all of these dynamics, which, again, it's the key term is uncertainty. And I think the other side of it is volatility, which we could talk about as well.
I think also important, if you looked at the dollar over the year, to your point about the clear loser, it had gained so much ground over world currencies in the wake of the election and has lost all of that ground, if not a little more. Now, if you look at that about face, you make this great point in a recent note that perhaps this volatility is not yet over. Can you explain the volatility that we might see in currency markets ahead and the ripple effect that could have on global markets more largely?
Yeah, it's important because what we've been highlighting is, again, you talked about in the last segment is uncertainty, and we've tried to measure uncertainty. We call it geo-macro, so geopolitics plus global macroeconomics. And you can look at data that underscores this term. And essentially what you see is there's an epic level divergence that we're seeing between what is measured uncertainty, which again, the markets tend to look at this. They say it's an externality. This is something we can't really understand. We're just going to ignore it, versus measured volatility, which we see across fixed income, FX, and equities. And what you're seeing is that one of these things is wrong. Either uncertainty is going to come down or volatility should go up. The point that we're highlighting is that when you look at the strategies and the factors and the things that are working in the FX market, they calibrate to one thing: low volatility. So if you kind of come into today's Liberation Day, again, I think this is a bit of a liberation for volatility, because I think what we're going to see is the focus here is really on the trade deficit, and the trade deficit is a concept about unwinding globalization. So the globalization we've seen for the last 20, 25 years since China's been part of the WTO, this is what's going away. This uncertainty is not unraveling. This is a regime change from a globalized global economy to something that's going to be much more nationalized, and we don't know what it looks like on the other side. So when we think about what's happening in markets right now, our positioning indicators are telling us to buy the dollar. And again, the vibe shift that comes through on European reflation and some of the things that would take over for U.S. exceptionalism aren't strong enough yet to validate the change in the positioning. So FX is always and foremost forever a positioning-based kind of market, especially when you think about it over the next month or 2 months. And the way that we're seeing is that the narrative change, the change in market positioning, the change in sentiment is missing the sequencing, which is U.S. growth can be okay for the next quarter, but you should be more worried about rest of world growth deteriorating, especially as what comes behind the trade uncertainty this month will be deregulation and likely tax cuts from the U.S., which would also probably provide a cushion for U.S. equities.
Mark, I want to bring you this call from Goldman in the last 24 hours. They say that the yen is really a place to go hide. This seems to be contrarian from what you're saying, but I want to get your view. They say that the yen tends to do best when U.S. real rates and U.S. equities are falling together, and it screens as a more attractive hedge for the downside view on U.S. growth than it has done for some time. They think that the yen could gain to 140 here. It's closer to 150 now. What do you think of that view?
I think in the short term, short term being the next 2 to 3 months, we just like being along the dollar. We think it's actually a better hedge. Again, you get the carry that comes with the dollar. You get positioning, which is moved to the other side. You get also short-term valuations, which cheap. And again, if you look at the structure of the market, the movement in positioning and all the short-term dynamics shows that EM carry and G10 are basically the same trade. The market's trading risk on. So risk on in currencies means you're long Mexican peso, you're long the Colombian currency, you're long Chile, but you're also long Euro and CAD in Sweden and Norway. And we basically see the same dynamics where they can all move at the same time. So I think yen's a good relative value trade. We actually have a cash trade on where we're short Euro versus yen. I think there's a central bank trade that you can play there. But I would say in terms of a hedge to the trade uncertainty that we are going through immediately, and something you could implement now, I would say it's a long dollar position. But I do agree, I like the yen as well. It's just more relative to G10 cross.
One other question I have, we had this great story from Bloomberg's Alice Atkins a couple of days ago about the liquidity trap that's been brewing in the currency markets. And you saw this worry really embedded in the leverage of the carry trade last year unwinding. How much do you worry about market liquidity here in FX markets, especially given the leverage under the system that would take years really to unwind by some measures, and also given the crowdedness of some trades?
That's a perfect point, because the thing that we've been stressing to clients as we've been kind of running around Europe is if you look at the correlations of the strategies that are doing well in FX, again, they all calibrate to volatility. And to me, that is the thing that is most obviously mispriced is volatility. It should be higher across a lot of different markets. And that can come through from data, or it can come through from trade uncertainty or geopolitical uncertainty. That could unleash it. But at the end of the day, the fact that the leverage strategies that are working are only working off of one general factor is scary, because they will all unwind at the same time. And liquidity will be a problem because, again, the way the FX market, it's a lot more electronic these days, and you'll run into air pockets and you'll run into some other liquidity issues. And the other thing is a lot of these trades are not really in deep hands. So you talk to clients around the world and you have conversations. People have ideas that they put in, but they're not in size. They're not going all in on an investment theme. So again, I think what could happen is if these things start to unwind all at once, everyone's kind of getting out of the same trade, and the drawdowns become much more severe, and they happen more abruptly in the short term. And that's kind of why we like being long the dollar here, because again, it's one where if all these air pockets start to move and the market moves against it, the dollar's just going to go up against everything because of the way it's gone down against everything. So that's where the liquidity kicks in, and it does put a premium back into the dollar. And again, that's what worries me is all these strategies are interconnected. There's not a diversification of strategies across FX where if this one does well, that one should do a little bit better. They're all kind of connected to the same theme, which is, again, what worries me for the way the market's set up for the environment we're in for the next month or two.
Mark, perfect setup. That is Mark McCormick of TD Bank, really keeping an eye on those gray swans, if not black swans, in what could be a very volatile market in the wake of these tariffs. Now, on to other top stories trending on the terminal this morning that we're keeping an eye on. Hedge funds, Millennium and Citadel, they extend their 2025 losses in a volatile month for markets in March. Millennium's flagship fund slid 2% in the first quarter, while Citadel's main fund extended this year's decline to 0.85%. And Wisconsin's judicial race delivered a loss for the candidate backed by Elon Musk. That's despite the world's richest man pouring millions into the campaign. Republicans, however, did manage to avoid upsets in two critical House seats in Donald Trump's home state of Florida. The votes were the first major election since Trump took office. And Republicans are in the process of drafting a tax bill that includes raising the state and local tax deduction, or SALT cap, to as high as $25,000. The cap applies to individuals and is currently at $10,000. The plan is being negotiated behind closed doors and is still being drafted. Now coming up, TikTok's future in the United States. President Trump is set to hold a meeting on the potential sale today. More on that next. This is Bloomberg. Now, President Trump will be meeting with top officials today to consider proposals for divesting TikTok's U.S. operations from its Chinese parent ByteDance. Sources say the administration is considering a deal that would include Oracle and Blackstone in a joint venture. The deadline for ByteDance to find a buyer is Saturday. Joining us with the latest, Bloomberg's Daybreak Europe anchor Tom McKenzie. How close are we to a potential deal? We have to remember that this deadline was already pushed before. However, Larry Ellison, of course, already quite close to the president with other major investments planned in the United States around AI. Could they cinch a deal, and will China be allowing it?
Yeah, all really valid questions as we tick down again to that time frame around TikTok. We're back to where we were in January the 19th, of course, when President Trump had to come in and extend the deadline for that deal. So as you say, the deadline is now Saturday, April the 5th. We know that the Vice President, J.D. Vance, of course, has been leading the negotiations. And as you say, it seems like there were a number of different individuals and companies that put their hats into the ring around a potential bid. But as you say, it seems like, according to our reporting, the leading contenders are a partnership between Oracle, Blackstone, the Financial Times as well, reporting that possibly Andreessen Horowitz might be investing to buy out some of the existing Chinese investors and holders in the TikTok business, of course, part of ByteDance. It seems the vice president has said that they're getting closer. They think they're going to get to some kind of deal. The president himself has said that he would be comfortable extending the deadline, though he might face pushback from Congress because, of course, this was bipartisan policy that led to the situation where you either face a ban or a divestment. There's a number of challenges in terms of getting this across the line, and one of the key questions that you point to is whether or not China signs off on a potential deal, and that depends on what the structure is. Crucial for China will be where the algorithm sits. It seems very unlikely that Beijing would sign off on any deal that sees the algorithm, which is the secret sauce for TikTok, being pushed over to the US side. Letting go of control of the algorithm seems to be a non-starter for China.
Tom, We thank you so much. We have to leave it there. That is Bloomberg's Tom McKenzie. Certainly, to your point, a lot of questions. That algorithm will be in key focus when you think about that TikTok sale. Now, stick with us. More on tariffs, more on the volatile markets ahead. This is Bloomberg. And it's time now for our front page news, a look at what's making headlines around the world. Now, first up on Bloomberg, a bipartisan group of senators, 50 senators, is readying a package of fresh sanctions to hit Russia and countries that buy oil from Moscow. The new sanctions are ready if President Vladimir Putin refuses to engage in good faith negotiations for a ceasefire or breaches any eventual agreement. And next up, the Washington Post reports that the White House is studying the cost of a takeover of Greenland. Officials have taken the steps to determine the financial consequences of Greenland becoming a U.S. territory, including the cost of providing government services for its 58,000 residents. And on the New York Times, Senator Cory Booker's record-breaking tirade against Donald Trump in the Senate. The Democratic senator from New Jersey held the floor in a filibuster that lasted over 25 hours, breaking the previous record set at 24 hours. This is Bloomberg. From our global headquarters in New York, welcome to the Bloomberg Brief. I'm Sonali Basak, in for Danny Berger today. Let's set your agenda. The countdown to tariffs. Investors await President Trump's announcement on levies. And the Trump administration weighs plans to divest TikTok's U.S. operations with proposals from Oracle and Blackstone. And Tesla set to release its quarterly delivery data after a brutal start to the year for its stock. But first, let's get you a check here on the markets, because you are seeing S&P 500 futures lower on the morning, down to the tune of 0.3%, even more so for the NASDAQ 100, down 0.4%. The direction all morning has been lower. Russell 2000 futures similarly down 0.4%. The bond market has been relatively stagnant this morning, but remember, we have come a long way. The two-year yield down about 0.5% since its January highs, and lower on the week. Same goes for the 10-year yield, 60 basis points or more of a decline this year so far, as investors anticipate a weakening economy in the heels of the tariff threats. On the heels of those tariff threats, the 30-year yield as well flat on the day as investors await those tariff announcements. The dollar this year has also lost a lot of ground, though moving only marginally on the heels of that announcement as well. Now, President Trump's tariff plans are still in limbo, just hours away from his White House announcement. His team is said to still be finalizing the size and scope.
Liberation Day.
Liberation Day
This is the beginning of Liberation Day.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away.
We're in the process of imposing reciprocal tariffs.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation, perhaps.
Friend has been oftentimes much worse than foe.
That money's going to be coming back to us in the form of tariffs. We're going to be very nice. Relatively speaking, we're going to be very kind.
Joining me now, Bloomberg Big Take podcast host David Gura, who's been following these tariffs closely. Now, Brendan Murray, who's our trade czar here at Bloomberg, and I were talking a little earlier about how President Trump tends to start with the tough stance and then have the opportunity to roll it back. Do we expect that out of the announcements from the Rose Garden today?
So I think this is very much in keeping with what we've seen in the past when he's rolled out policy. Of course, as you saw there, he's ballyhooed this for a really long time now, and I think it's kind of in keeping with the level of uncertainty that we've seen throughout this entire process. But our understanding here at Bloomberg is, yes, a lot is still on the table, and you'll recall that when he was running for president the second time, he talked a lot about a universal tariff. That apparently is still something that he's bandying about. Could be a tiered system, a more tailored approach. I guess another question now as we watch this meeting this afternoon, this announcement this afternoon, is sort of when does that tailoring take place if he goes that route? And we got indications yesterday from the White House press secretary that this president is still open to negotiation on a lot of these tariffs. And I suspect that that's going to just prolong the level of uncertainty that we've seen here going forward. You're going to have executives and foreign leaders, finance ministers all trying to find ways to lower these tariffs if that's in fact the route that he goes. But again, very much in keeping with the level of uncertainty he's kind of maintained throughout this entire process.
You know, while we wait for these announcements, and of course a lot of uncertainty even into that announcement, you've been talking to many people from around the world, finance ministers, to see what the reaction would be. How do you expect the fallout to play out?
I think that it's a much more well-aligned and coordinated kind of response than we've seen in the past. And so, yes, I was up at the G7 foreign ministers meeting in Canada. Those foreign ministers talked a lot about how they're finding new alliances among themselves. They're going to take a tough stance on whatever the president decides to put in place. There's still this element of confusion and surprise. They're kind of questioning why this is happening, the rationale for it, but they've moved beyond that very quickly to kind of come up with concrete answers to whatever this is going to be. They're going to work together for whatever kind of reciprocal tariffs they need or want to put in place. And I think that that's something to be watching for here in the weeks ahead, is how that kind of strong stance manifests itself in the response that they have to this.
Now, it's interesting. Back here at home, it's kind of hard to keep track of all that's going on just in Washington today alone. But you also have the Republican Party gearing up for the next phase. It's not just tariffs, it's about taxes as well. And the idea of the SALT cap, looking at that $25,000 level, Republicans proposing this, how much are they trying to bring blue states on board here?
They're trying to do it. Obviously, this is like fundamentally important to folks in New York and New Jersey, Connecticut, Southern California to an extent. But every vote matters now in this Congress. And so I think Republicans are aware of the fact that they have to cater to this group of folks who really care about this state and local tax deduction. Of course, this is something the president did away with during his first term. He lowered it to $10,000, a lower threshold, wants to raise it once again. I think we're beginning to see kind of the negotiations around that. And you're right to say there's so much going on. The sequencing of this is hugely important. I think there are a lot of people on the Republican side who kind of wish that the president had approached taxes before he got into tariffs in earnest or as fully as he has. But this is certainly the thing that's going to occupy a lot of oxygen going forward here, and we'll see sort of how they work around the edges.
Right. How much of this is an attempt from lawmakers, particularly Republican lawmakers that are looking to support the president in tariffs, saying, well, wait a minute, you're going to get tax relief. Look around the corner now before it gets too painful on the tariff front.
And I think that they think that this is the thing that their constituents care the most about. I think there's still kind of wider spread confusion or a lack of understanding of why the president thinks that tariffs are as important as he thinks they are. This is something I think that the constituents really want to see happen here. So they're kind of adamant that it becomes something that, yes, the administration, but Republicans in the Congress focus on as well. And I should say, this effort is being led by Mike Crapo of Idaho, Republican. He's saying here that everything's on the table now. They're trying to figure out sort of what's going to work, but it's still very early days yet in terms of what happens.
David, we thank you so much for your time this morning. We're very much looking forward to your coverage. You know, you've been on the road. That is Bloomberg Big Take podcast host David Gura. And don't miss our White House tariff announcement special this evening. That's live at 4 p.m. New York time. We will break it all down for you and how to think about the impact on markets moving forward. Now, joining us now, Adam Posen, president of the Peterson Institute of International Economics. Adam, you are really the perfect person to talk to about the fallout and what can be expected. First, I want to point out what you have recently written and what you have been trying to warn, that this will not generate even half of the revenue that Navarro claims, 2% of GDP at most annually. If that would turn out to be true, then what is the purpose ultimately of these tariffs, and how will it change the texture of the American economy?
Good to be with you on the briefs and all. I think this is part of two goals. As you kindly said, Peterson Institute, a bunch of other independent assessors think that there's a Laffer curve in the level of tariffs, and it's somewhere between 15 and 20%. And if you get up past that, you end up collecting less taxes the more you go up. And even that overstates it, because the 2% you mentioned a year, which is real money, is before you start computing a dynamic score of the negative effects the taxes have on the economy, which in the end reduce growth and reduce revenue as well. But you're going to a more fundamental question, which is, what is this for? And I think it's for two different things. It's actually for several, but two big things. The first is straight up the president and some of the people around him who he's appointed just ideologically believe other countries are ripping us off through free trade. It's a wrong concept. We get stuff when we buy it. But nonetheless, they just believe this, and they believe that the tariffs will somehow change that. And it might reduce the volume of trade, but it won't make us better off. The second thing that they're trying to do is do a fundamental revision of the tax code in line with a lot of things the Republican Party and pieces of the Republican Party have wanted to do for a long time. And so I think part of the goal here is to replace a lot of income tax, particularly corporate income tax and high earners income tax, with consumption taxes. And the tariffs are a form of consumption tax. They're an inefficient form of consumption tax. As my colleagues Mary Lovely and Kim Klausing at Peterson have documented, they'll cost the average family $1,200, $1,500 a year and more the further down the income scale you go. But it is a way to shift the burden of taxation from companies and high earners onto people who may not even pay taxes now, but then would be paying taxes on the things they have to buy.
So let's bring in the cross currents of that extension of the Tax Cut and Jobs Act. How much do you think that would actually spur growth if people are concerned that the tariffs will stunt it?
Good question. I think the feedback we're getting, the negative feedback on expectations, both in terms of consumers scared to make large purchases and consumer confidence going down, but particularly corporate investment, that we have people who depend on imports for things they can't substitute, at least not for a few years until the U.S. starts doing them, is holding off on investment. They're holding off on making plans. So the uncertainty is there. But to pick up on something David Gura said, and you said, that the uncertainty isn't going to go away. I think the president is likely to announce across-the-board tariffs of 15 or 20%, and then announce 4 or 5 sectors where, like auto, steel, pharmaceuticals, chips, where they're going to focus additional tariffs. And then there'll be uncertainty about creating exemptions, additional tariffs, non-tariff barriers. So this is a change in regime to a regime of ongoing uncertainty. How big a drag that is versus some of the positive for growth things this administration does, some of the direct or offsetting effects of tax cuts remains to be seen. But we're already, when I was warning about this last fall, including on this program, people were saying I was exaggerating, and now we're seeing uncertainty effects that seem to be larger than even what I was told was too extreme.
Now, I also want to point out some of the math that was put out from the Committee for a Responsible Federal Budget just earlier this week. The idea by the end of 2055, so it's a while from now, but you can see the trajectory here. The idea that in nominal dollars, debt in the United States will grow by $108 trillion from $30 trillion at the end of this year to $138 trillion by the end of 2055. And you compare that with what Peter Navarro, of course, which is one of the most hawkish trade advisors to President Trump, he said that $700 billion, we're talking billions of dollars, hundreds of billions of dollars from the tariff revenue being discussed. To what extent does the tariff revenue actually start to close gaps in the American economy, if at all?
There's Congress world and there's real world projections, right? So the Committee for a Responsible Federal Budget and other respected nonpartisan agencies are always doing, as we at Peterson are trying to do, are always doing 2 exercises. There's an exercise of projecting what's going to happen for purposes of the congressional process, what's called reconciliation, that allows the Senate to pass a budget without having 60 votes. And that relies on specific baselines and specific assumptions. And again, you're only allowed to include the first round effects because it becomes highly speculative, even though we can make judgments about what the second and third round affects. So the bottom line is, if you move to across the board tariffs, and therefore it affects everything, and crucially, Congress passes them, it's not just something the president can put on and take off, then you can do a projection according to the rules. And if you do a projection according to the rules, the one I carry in my head is the 10-year window, so to 2035. And then you're talking about numbers like $300 billion a year at most, probably more in the $250 billion a year range if the legislation passes Congress and the president doesn't give it away. Mm-hmm. That's real money. But then you're talking about what happens to the actual economy evolving out, as you just said, out to 2050, out decades. And there we've still got an imbalance because we're cutting back on the amount of taxes being collected with the renewal of the 2017 taxes. And the amount we lose from that increases over time because of inflation, because of biases in the tax code. And so we're actually going to lose more revenue on net. And that's if you only look at specifically the extension of 2017 and the trade. If you put on other things, you lose more money. Sorry.
Net, where does money go? Because there cannot be a lesser debate seen in markets about where to hide. You had TD Bank saying that the dollar is where you should look. You have Goldman Sachs pitching the yen as a safe haven at this juncture. Do you think that more money is going to flow into or out of the United States?
It's a really good question. Normally, when an economy puts up tariffs, you get money inflows. And normally when the U.S. threatens other people, even if it's not very nice of the U.S., to put it in Trump's terms, money flows in because people want to placate the U.S. The last couple months, though, things have changed because of foreign policy. The U.S. administration has undermined alliances like NATO with Canada and basically said agreements don't mean what they used to mean. So I think you are going to see a rotation that particularly Europe, but also non-Europe G20 economies are going to gain. Not so much Russia, obviously, or China, but all the others, including countries like India, Indonesia, Brazil. And this is a hedging matter. And if this is sustained over time, that gets reinforced because then the trade flows start to edit out the U.S. They start to say, okay, we do stuff just for the U.S. market. We put production in North America just for U.S. and Canada, but the rest of the world has to go on about its business. And that will also reinforce flows out from the dollar. So this could be a historic turning point, not a crash in the dollar, but a much more earlier change in dollar valuation than I would have expected.
Adam Posen of the Peterson Institute, we thank you very much for joining us ahead of these long-awaited tariff announcements. We will keep an eye on it for you throughout the day, and don't miss that 4 p.m. special tonight. Now, coming up, Walmart continues to push Chinese suppliers to cut prices despite pushback from Beijing. More on how companies are bracing for President Trump's tariffs next. This is Bloomberg. This is the Bloomberg Brief, and I'm Sonali Basak in New York. Now, Walmart is continuing to push Chinese suppliers to cut prices despite pushback from Beijing. According to Bloomberg sources, it asked suppliers to slash prices by as much as 10% for each round of tariffs. Joining us now, Bloomberg's Samson Ellis. What is Walmart trying to achieve ultimately, and will they be successful?
Well, this is obviously all about keeping prices down, which is something Walmart has made a key part of its brand in recent years. And so in many ways, this is just business as usual for the world's largest retailer. So goods made in China and then shipped to the United States have seen new tariffs of 20% put on them since the beginning of the year. And of course, that's before we even get to Donald Trump's Liberation Day barrage of reciprocal tariffs that we're expecting to see at some point later today. And while discussing this, it's important to point out that these negotiations Walmart is having are arranged by product category and are not necessarily targeting just Chinese suppliers. They're very keen to point that out. But these types of negotiations are absolutely par for the course between Walmart and its vast array of suppliers, and of which they have, very many in China. But the real point of contention here, obviously, is who bears the main burden of these new levies, the manufacturer or the retailer. And in many cases, these conversations that are ongoing have not come to any kind of firm resolution. The manufacturers we've spoke to in many cases have said that they simply cannot afford to see their margins squeezed any further.
Maybe I'm missing something, but clearly there has been pushback from Beijing. Why would they now come to the table?
Well, obviously, this is happening at a relatively sensitive time in US-China relations. In China, many things do have a political aspect to them as well. So as we sit on the cusp of these new tariffs that are about to be announced later today, and with the US administration administration being very explicit that they view China as one of the United States' key trade rivals. These talks are not happening in a vacuum. So considering that, the response from China, the Chinese government at least, has been relatively muted. The worst Walmart has seen so far is a slightly irritated social media post saying that these talks are going to harm US and Chinese companies' interests.
Bloomberg, Samson Ellis, we thank you so very much for your reporting. Now we want to switch to another company story. Tesla set to report its latest sales numbers today. Wall Street expectations have come down sharply as CEO Elon Musk's political maneuvering fueled consumer backlash, eroding global demand for his electric vehicles. Joining us now, Bloomberg's global autos editor, Craig Trudell. One thing I found fascinating was the jump you saw on the initial reaction in Tesla stock price after Ford's release of their own numbers yesterday, where you did see probably higher electric vehicle demand than expected. But will Tesla see the same given the political overlay that it's faced?
Yeah, I think that's a key question. I think, we saw yesterday, not just Ford, but also GM and Hyundai, manufacturers post really strong first quarter sales and talk about this idea that they saw a sort of mad dash this past weekend, that buyers wanted to get out ahead of the tariffs and sort of rush to showrooms to get vehicles to buy them before prices went up. And I think even Elon Musk has sort of set some expectations here that even despite the fact that Tesla makes the vehicles that it sells in the U.S., they too will be hit by tariffs. And there is an expectation that, perhaps the company would be sort of caught up in, the back and forth between, countries trying to retaliate against the U.S. And so there's risk here for Tesla, going forward, even if this first quarter number ends up being less ugly than everyone anticipates.
Tesla down to the tune of more than 1% pre-market. Bloomberg's Craig Trudell, we thank you so very much and looking forward to seeing your analysis of these numbers. Now, coming up, we're going to get you set up for your trading day, a huge day ahead. It's Trump's Liberation Day. This is Bloomberg. This is the Bloomberg Brief. I'm Sonali Basak here in New York. Let's look ahead today, starting off with some economic data with ADP at 8:15 a.m. Eastern Time, followed by factory and durable goods orders at 10 a.m. And Fed Governor Adriana Kugler speaks at 4:30 p.m. And the main event of today, President Trump's Rose Garden address at 4 p.m., unveiling his tariff plans. I also want to bring you some micro movers under the surface. Charles Schwab rising after Citi raised the stock to a buy, and Truist is lower after Autonomous rates the stock a new underperform with a price target of $42. Remember, bank earnings kicks off next Friday as well. Newsmax is falling double digits after surging 2,230% in 2 days after its debut on Monday. And a quick check of the markets before I let you go. With futures lower ahead of that big tariff announcement from the U.S. president, the Bloomberg Dollar Index also lower with a big debate on how to play that dollar. The 10-year standing stable, though a massive decline this year to 416. Now that does it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.